Okay, and Ron Millos, our Senior Vice President of Finance and CFO, is going to lead you through a finance presentation. So over to you, Ron.
Great, thanks, Greg. I'll try and go through pretty quickly here because a lot of the things I'm talking about, unfortunately, Don already spoke to them, so I won't duplicate what I was going to say here. I'll speak briefly to the cost reduction program, just summarize our financial policies, talk a little bit about our debt and credit metrics, liquidity, financing alternatives, a couple of things for some earnings considerations, and I've got a couple of slides just on our sensitivities and guidance. I'm not intending to speak to those, but they're just here for you in one place. There are no substantive changes from our quarterly reports. So just on a revenue perspective, Don gave you a little bit of a summary of where our customers are. These are our 2012 results, and they're not expected to change substantially. But the only comment I'd make on the revenue is this is a consolidated total. When you look at it on a commodity by commodity basis, there is a bit of variability. So as an example, in the Asian markets, China, Japan, Korea, account for 51%. China and Japan are major customers for coal, copper, and lead concentrates. Korea takes zinc concentrates and coal. In the U.S. markets, they're taking mainly the refined lead and the refined zinc. Canada takes the specialty metals and the gold and the silver. And the Europeans, they take a bit of copper, a bit of zinc, a bit of moly, and a bit of coal. So that's just a breakdown. From an operating profit or gross profit perspective, the business units, coal again is about 50%, copper about 35%, zinc about 12%, and the year-to-date numbers for 2013 are very similar to these levels. I'll just move on to the cost reduction program, and as Don mentioned, our current target is $330 million. That was up from $200 million when we started the program last year. We have implemented $300 million of those ideas or initiatives, and so far we've realized about $205 million. In addition to that, we've got about $130 million of sort of one-time or non-items that we can defer into future years. So we're moving quite forward, or we're quite happy with the progress we've made on those programs. And just to give you a sense on how we account for these, so to be eligible for this program, the action has to arise from management action. It cannot be related to changes in production volume. So if we cut production to cut costs, that's not in the program. And it can be related to price changes. So if the price of oil goes down, that doesn't count, unless the purchasing guys managed to negotiate an extra discount or something off of that. The measurement was based on our expected costs that we had when the program was started, tail end of last year. We have included or netted off any additional costs. So if we had some staff reductions and had to pay severance for that, it's a net number, not the gross number, all measured on a pre-tax basis. And anything where we've extended life, what goes into the calculation is a depreciation. So for example, computer equipment, our laptop computers, if we said, let's replace them every 5 years instead of every 4 years, you get a 20% saving in the depreciation expense. So that's sort of how we're measuring these particular items. So there's numerous categories of savings, many different items on the tracking list, many exceeding $10 million each, many in the several $1 million, lots less than $10,000, but they all add up to large dollar amounts. There's about 220 different initiatives on the $330 million program and another 100 initiatives for sort of the deferral type programs. Sounds like a lot of initiatives, but we have 13 sites. So it's about 25 to 30 on average per site. So it's not an overly burdensome program that we have in place. And really what we're seeing from the employees is that they're embracing the idea of the cost reductions initiatives. They're questioning all of our expenditures. And really our goal is to force people to think about what they're spending money on, and for those things that they do need to spend money on, we want to make sure that they're spending it wisely. So in summary, the type of cost savings that we're getting, about a third of it is labor related, and that's due to staff reductions, overtime reductions, and less use of contractors. About 25% is maintenance and operating supplies, and about another 25% is about related to about throughput improvements. And on a business unit basis, it matches up quite nicely with how our operating profits is split between the business units. And I'll give you a few examples of items that are on the list. For example, we've got 37 million in there improvements in haul truck productivities, and that's all over the site, so it all adds up to a large number. $17 million in savings from lower prices that the guys have been able to negotiate from our suppliers and on some of our contracts. $16 million for overtime reduction, $15 million for manpower reduction. Half of that was the staff reductions we did down at QB earlier this year. And then, of course, when you look at some of the smaller items on the list, and they all add up, we've got $120,000 for scrap recovery, $50,000 where we wash air filters on the sites instead of sending them out to be washed. And at a real trivial level, our annual report, one color instead of two colors saves $10,000. So there's lots of tiny things that people are starting to think about. And, you know, we've got roughly 14,000 employees. If everybody can come up with 10,000 of savings, there's $140 million there. So it's the mindset that is starting to kick in, and we're quite pleased with how that's working out. Moving on to the financial policies, maintain investment grade credit rating is extremely important to us. Make sure we have sufficient liquidity, unused credit lines, $2 billion at the end of the year, and we're also sitting on a little over $2 billion of cash. Our cash is held in low risk, highly liquid investments. Don spoke to the share repurchasing consideration, so I won't duplicate that. Moving on to the next slide, limited price risk hedging. We're not big hedgers. We believe shareholders invest in Teck for exposure to commodity prices. So our general practice is not to hedge, except on occasion, to preserve major capital investment economics. Don spoke to that. Protect the financial viability of the company. We did a little bit of hedging back in 2008, 2009, around the time of the global financial crisis. We do consider buying Canadian dollars forward to protect the operating margins in our coal business, and that's because of the fixed price nature of the sales contracts on the 3-month or the quarterly contracts. We look at, on occasion, energy input cost hedging for Red Dog's fuel purchases, and that's tied in with the shipping window there, where we have to buy all the fuel in about a 3-month window because of ice conditions. And we'll consider one-off commitments in foreign currencies to fix the cost of significant purchases from time to time, but those are all things that we consider. We don't necessarily act on every single one of them. Moving on to our balance sheet, as Don mentioned, quite healthy balance sheet, $325 million of debt due to early 2017. Interest rates now about 4.8% on a coupon basis, a hair over that for accounting purposes with the discounts and all the issue costs. Maturities average about $600 million, so it's in pretty good shape there. Our credit metrics. Again, these are our key financial ratios. Debt to debt plus equity is currently 29%. Our target is less than 35%. Leverage ratio 2.5 times or better. We're there now, and our interest coverage is greater than 6 times, and we're certainly there now. These targets are all set to maintain our investment grade credit rating. We can, on occasion, exceed these limits if we see a very quick way back to those. So it is possible that on occasion we would exceed those targets, but only if we see our way back quickly. And if we're going to do something where we exceed those targets, we would generally go to the rating agencies for indicative ratings before we do anything. And our ratings, excuse me, are all mid-triple B with stable outlooks. We like this mid-triple B range. It provides us a notch, a cushion against a general industry downgrade for something that could happen that's beyond our control. And as Don mentioned in our third quarter report or third quarter investor call, we were non-investment grade for a period of time. We got out of there as quickly as we could, and we really don't want to go back there again. Liquidity, I mentioned earlier, $2.25 billion of cash at September 30th. We have $2 billion of unused credit lines, so this provides us with sufficient access to capital to finance the development projects that Don mentioned earlier. With the financing alternatives, EBITDA and cash flow that the business units are generating is still strong. Last 12 months, EBITDA was $3 billion, $4.25 billion of liquidity that I mentioned earlier. With our credit rating, if we had to go to the public markets for capital, with our credit rating, the markets are open to us. Something like a QB, if we were to move ahead with that, we would look at whether project financing might make sense. It's another source of capital that we don't normally go to, but it's something that we will consider. Whether we do that or not will be dependent on the circumstances at the time. And of course, asset sales, Don mentioned the gold assets, and in the past we've talked about if Frontier ultimately goes forward down the road with we'd consider bringing in a partner after we've taken it through the permitting process to add value. So those are things that we could do if need be. Just earnings considerations. I just want to remind people of some of the odd things that we do face. Red Dog's shipping season can have a big impact on our zinc sales, and whether that season starts early or finishes late or how it works out can have an impact on our quarterly results. For those of you that are tracking us on a quarterly basis, those are usually short-term timing differences, but they can have an impact. Our coal operations operate in the Rocky Mountains, so winter weather can hamper operating conditions on occasion, and they can disrupt our rail transportation to the ports. In addition, at the ports, windy weather can hamper loading, and again, that can have a quarterly impact. Most of these things are generally dealt with relatively quickly, unlike the Australians that have the flooding where it takes them months and months or years to get through it. Ours are usually days or weeks to sort those types of things out, but again, can provide significant volatility on a quarterly basis. Tax pools in Canada, we have a little over $6 billion of unused tax pools. That doesn't have much of an earnings impact, but it certainly has a cash flow impact as these pools shelter our Canadian source income from cash taxes. You're all probably aware that we've got the pricing adjustments on our concentrate sales. Depending on how you try and model our results, remember to factor in the refining and treatment charges and exchange rates, and tax rates, depending on whether you're looking at EBITDA or the bottom line. And lastly, we've got the new accounting rules for the overburden removal or the deferred stripping costs. Those are new rules. They're quite complex. They don't really have any impact on how we mine or how we operate the business, but they do affect our earnings and they do affect our financial statement presentations. So just be mindful of those numbers. So just a little bit more on taxes. Basically in Canada, our mineral taxes need to be factored in. So our all-in tax rate, barring any unusual items, should be in the sort of 35 to 40% range, and a little bit of movement depending on the jurisdiction contributing the earnings. Unusual items can be taxed at capital gains rates, or they're non-taxable items, so those can have a big impact. And the one thing that can really have a big earnings impact is changes in tax rates, because our deferred tax liability is about $5.8 billion. So if there's a change on the tax rates, that can have a huge impact to adjust that deferred tax liability to what we expect the taxes would ultimately be paid at. And so, you can easily see that there's, $20 to $50 million one-time hit could occur depending on when or where those tax rate adjustments are made. Leverage to our key commodities. I won't speak to this in detail. It's just here summarized for you, but coal and the Canadian US dollar exchange rate are the two that have the biggest impact on our EBITDA and our bottom line. Lastly, the current guidance. This is information was all provided in our third quarter report. It's a takeaway just to put it in one place for you. And the one thing I will highlight in our Q3 investor call, we did say that for the production of coal, we expect that we would be near the upper end of the guidance range. And for the cost of sales, we would be near the lower end of the guidance range. So in summary, from a financial perspective, we're in pretty good shape right now. Would certainly like to see higher commodity prices, but that's kind of beyond our control. Got a strong focus on the cost reduction program with the $330 million target savings, and that compared to, like Don mentioned, $200 million when we started the program. Balance sheet is very healthy, lots of liquidity, $325 million of debt due between now and early 2017. So all of this puts us in a pretty good position to finance our capital spending and any other investment opportunities that present themselves. So with that, I'm happy to take questions.
Thanks very much, Ron. We'll work back your way, Horst.
Ron, how long do you think it would take to realize the $330 million of initiatives that you've identified?
Well, we've got $205 million is what we've realized so far, so probably somewhere in the 3 to 6 month range. A little bit of strays coming in here and there type thing, but...
I'm just wondering how we should think about the capital allocation for spending for Fort Hills and QB2. Do you think the balance sheet could fund both those projects simultaneously, or do you think we should think about QB2 funding coming after Fort Hills?
Well, QB2's delayed, so it's, if Fort Hills goes forward, we're going to be well through that, probably 3/4 of the way through that before the major spending on the QB, if it moves ahead and gets the permits. Kind of hard to answer the question, Horace, because I'd like to know what the commodity prices are going to be a couple of years down the road. But certainly, we'll be mindful of what the balance sheet looks like, what our view of the future commodity prices look like at that time when we have to make the decision on QB. So it's a decision that's kind of been made for us, so we don't have to really deal with it right now, but we will probably in about 2 years' time.
Ron, let me try to ask that a little bit differently. When you look at your investment grade credit rating, and you say you want to be, in that fringe of, one above the bottom notch, what should we be looking at in terms of metrics, financial metrics as you go forward, and you invest your capital, and you have, cash on the balance sheet or commitments?
Yeah.
What type of metrics should we be focusing on?
The metrics that I gave, the targets that we've got on the slide before, maybe I'll just blast back to that if I can get there quick. There we go. If we can maintain the balance sheet at those levels, we should be okay. And the rating agencies, this is a mathematical, we can do the math. What you don't know is what the rating agencies' views will be on future commodity prices or events. So there's lots of things that they consider besides the pure math. But if we can finance it with cash flow, because commodity prices pick up, then we should be no problem. If we need additional debt or financing for that, go back to the agencies, give them the forecast, give them the plan to get back into these targets within a quick period of time, see what they have to say, and if they bless us, then we would consider going forward. If they don't, we'd have a decision to make.
But can you just define quick period of time? What is that, 12 months?
No, probably 1 year to 2 years. Yeah.
Ron, you've talked about possibly getting sustaining CapEx down to $500–600 million next year. Just wondering, what is the same number for capitalized stripping, a long-run sustainable number?
We're in the middle of our budgeting process right now, so it's hard to give a definitive answer, but order of magnitude, it's probably going to average about $500 million a year over the next 5 years, but again, we're still cranking that through. it's new and it's a bit of a difficult calculation. As you change the mine plans and where you actually mine, there could be some pretty wild swings in some of those numbers. And I'd like to sort of go through a few years and sort of get a better feel for what the volatility we may like. But that's an order of magnitude number.
Ron, Jorge with Deutsche Bank again. Could you comment about potential write-downs? I don't know if you're getting, as you're going into the end of the year process with accountants, obviously it's been widely known in the mining industry, everybody's been taking write-downs. You guys have managed to avoid that, but it is difficult to believe with changing commodity decks that you would not be seeing some of the things impaired, such as perhaps Quintet, which has been suspended. I don't know how you would treat the sort of $200 million that's gone into the ground so far, or is this an open-ended thing because you continue to commit to building it?
We look at it pretty much every quarter, and so far we've managed to skate through on the coal assets. We looked at it pretty hard back in 2008 and 2009 and didn't have any write-downs, because you have to remember some of our assets were acquired at a very low cost base. I think the coal assets are pretty safe. Something like a duck pond, which is nearing the end of its life, those are the ones that are at risk, but the book value there is quite small. So, we may have some, but they're not, I'd be shocked if their order of magnitude might be 100 or a couple $100 million. They're not going to be billions of dollars type thing. But again, that process hasn't been completed. Depends on the plans going forward. Our long-term price assumptions haven't changed. Even though short-term prices might be a lot lower, our outlook going forward is what counts. So, I certainly don't expect what you've seen with some of the other companies, but until we do the analysis, it's hard to give a number.
Ron, a quick question on Quintet. If that project gets approved, you think you have enough financing for that, or could that require additional debt?
Maybe a small amount, but I think that one's probably one that, depending on what your view, again, depends on what your view of the commodity price is going to be. If it goes ahead, we probably got a pretty good view of the commodity price and the demand for the product. So I wouldn't expect that there'd be huge amounts of external financing required for that particular project.
One follow-up?
Yeah. So you could be potentially spending on that next year along with Fort Hills.
The decision is in the spring would be. I won't say what decision we'll make, but that's the next look-see for that particular project.